Starbucks getting a lift after matching earnings expectations and coming in late on revenue. The company's CEO saying efficiency efforts are tracking ahead of expectations. Joining us now to break the quarter down is Citi restaurant analyst Jon Tower. Jon, it's good to have you on. I mean, global same-store sales fell 3%. China in particular, very, very weak. North America also down 2%, but perhaps not as bad as feared after two really rough quarters. Your take?
Yeah, I think you hit the nail on the head, right? The U.S. business, I think, came in slightly better than feared with respect to aggregate comp. The traffic's still down 6 and decelerating on a multi-year basis. Not that encouraging, but on the flip side, the cost savings are starting to show up in the model, first on the COGS line, but also on the G&A side. So, management has been talking about the idea of seeing some cost savings roll through the model over time. We're finally starting to see it show up here in one of these quarters. On the other side of it, China not looking so hot. Another quarter where comps disappointed, transactions were down. It looks as if, the recovery over there is really just stalled out. And while it's still a small piece of the puzzle for Starbucks with respect to overall, revenue and EBIT contribution, it is one of the longer-term growth drivers of the business. And that seems to be kind of just stuck in the mud at the moment.
And certainly we're seeing that and hearing that from a number of consumer-facing global companies where China and the Chinese consumer relates. But if I look at Starbucks, you got pressure from Elliott. So you got activist investor pressure on one end. You got pressure from the founder and now multi-times former CEO Howard Schultz on the other end. Does this do enough to calm some of those concerns? Will we look back on this and say, OK, this is the quarter of bottoming?
I don't think so. I mean, look, a potential activist investor in here could be what would, at least keep the stock in this kind of $70+ range. But from a fundamental standpoint, we're still seeing decelerating trends, which is not encouraging. And with all of the initiatives that the company put out during this quarter, particularly in the U.S., when it comes to energy drinks, boba, all the deals that were coming through the app, it's disheartening to not see traffic improve sequentially, improve that much, especially if you look at all of the deals that they've been doing. And, the cost savings are nice, but I don't think investors really want to pay for cost savings. They want to see sales growth over time. We'll get an update from management on this call with respect to their guidance for this year. I think it might be a little too early for their commentary on fiscal 25. So I think we'll still be kind of feeling around a little bit in terms of how they're expecting unit growth to play out next year and their expectations for overall top line.
Jon, I'm wondering how much of this is just Starbucks being this higher priced company at scale, certainly in the U.S. and some significant scale in China, too, when the macro environment has changed and even people's habits have changed. Maybe I've got a little bit too much of an urban perspective, but I think of Starbucks as something that a lot of people do during breaks at work. If people aren't going into work physically as much as they did before, does Starbucks have to retool where they put stores, how stores are organized for the way culture has shifted? And can you entirely blame them for that?
Well, look, I think a lot of other companies are dealing with similar situations, but their traffic isn't down as much as it is here. I think it's more to the broader point. Our price point's too high for the company, for the average consumer. When you've got a store base north of 16,000 stores in the U.S., you're effectively the second largest footprint when it comes to stores in the United States. Should you still be, offering premium price points, or really that's your entry level price point? Should you rethink the menu architecture where perhaps you introduce everyday value to the menu to kind of drive that, lower frequency customer to come to your store more often?
So McDonald's.
Yes. I mean, does it make sense to kind of move down that path of, hey, we're too big now to offer premium price points only. Perhaps we need to get more aggressive on everyday value to get those customers back in the door. You've already got a massive loyalty program, and that doesn't appear to be moving the needle here. So you got to figure out something else.